Hello, everyone. Today on the final bar, we'll talk about a market continuing to push higher. I'm back after a week away, coming back with a vacation beard, taking a fresh look at all the charts. And again, I would argue not much has changed since last week, except the FAANG stocks. I think what's most impressive, the chart of Microsoft and others pushing higher, really propelling the S&P to further highs. But what does that mean on a heavy earnings week? Ladies and gentlemen, this is the final bar. Hello, everyone. Happy Monday and welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together using the power of stock charts, using data visualization techniques to get a better read on supply and demand, sentiment, all of those good things, all those emotional drivers that affect stock prices. I was watching earlier today the latest episode of Behind the Charts where I sat down with Michael Kahn. I mentioned supply and demand just a moment ago. Maybe think of my conversation with Michael. If you missed it, definitely check it out on our YouTube channel or on Stock Charts TV on demand. We talked a lot about just thinking about supply and demand and how to simplify, not make things more complex, but make things more simple and coming up with ways of understanding supply and demand. And as I was reviewing the charts, yesterday and then today preparing for the show, I'm struck by the supply and demand picture. What's changed since in the last couple of weeks? We're going to go through that. Overall, you're going to see certain charts certainly confirm this market going to new highs. Certain things not so much. There are plenty of things that are pulling back, still sort of in a choppy range. I don't know how much has really changed in the last week, but we're going to look at the charts and try to define that together. Having said that, we have great guests on this show, and I'm so thankful. I'm honestly very excited to get back. I enjoy doing the show a great deal and love having some of these conversations. Tomorrow, we have Mark Ungerwitter from Charter Trust. That's on tomorrow, the 13th. On Wednesday, the 14th, a Stock Charts contributor and fellow TV host, Dave Landry. And then on Thursday, the 15th, Mr. Wyckoff, Roman Bogomazov, he runs a firm called Wyckoff Analytics. It's a beautiful way of visualizing supply and demand, a framework for understanding the markets. Then just so you know, this is Options Week here on Stock Charts TV. Danielle Shea from Simpler Trading did a fantastic job with a live trading room earlier today. We have Tony Zhang from doing a special this week as well. And then coming up this Saturday on the 17th, we have an Options 101 panel. I'm sitting down with Price Headley from Big Trends. Who else? Lex Lutheringhausen from Tradier, Sean McLaughlin from All Star Charts and Trade Ideas. It's going to be a lot of fun. Just if you've not ever looked at the options market and have considered it, hopefully this will be a panel that resonates with you. We're going to talk with some experts about how they got started and some suggestions, some recommendations, and how you can go about things in a proper way, in a disciplined way. Let's get to our market recap today. On the final bar, looking at the S&P, so essentially not much change from Friday. And again, I'm coming in with some fresh eyes. And when I was looking at the charts yesterday, kind of getting ready for the day today, I was struck by the push higher on Friday, going into Friday's close on the S&P. You see the acceleration to the upside in the last hour and on Friday. And I don't like to, take the entire week and summarize it on Friday's close, but it's worth noting when a market, finishes in a position of strength or weakness. That's something we've often talked about. And some of the warning signs we've been talking about in recent weeks have been some of the weaker closes that we saw. That changed last week. You saw a lot of movement higher. Today was not much of a directional day. Essentially, the S&P was flat. Most indexes were essentially flat. This is what I would certainly call a digestion day. The market making new all-time highs last week. The S&P closing above 4,100 for the first time, and then getting into today, and it's more of a digestion day. Now, there are a lot of earnings on tap for this week, especially in the financials. We'll talk about some airlines and other things. So certainly a holding pattern of sorts. The VIX, by the way, is really low. I was struck by how low the VIX has gotten, below 17 now. Looking at other markets, the 10-year yield staying just below 170, which again is pretty elevated relative to the last year, very not elevated relative to the last any other time beyond a year. I mean, we're still at all-time lows if you look at the long-term trajectory on interest rates. I think there's certainly plenty of upside that could be had there. Rates moved, essentially up a bit today, but not much to speak of. And the dollar relatively stable today, not much of a change from Friday. Looking at some other asset classes here, just to finish things off. Commodities essentially mixed. You had oil, natural gas up today, gold, silver, precious metals weaker, and the miners that we've talked about. Certainly one of the weaker groups I would come up with would be probably the XAU or GDX or one of those. Gold stocks have certainly not been an attractive place. Gold continuing to see some weakness with the GLD, coming off from Friday's close as well. Cryptocurrencies, I'm not surprised to see Bitcoin around 60,000 and having broken above there, in recent days. We've talked about the long-term trajectory. I certainly could see a technical justification for further upside with Bitcoin today. Not much though, a lot of chop around, but in the end didn't really change much from yesterday. And overall, cryptocurrencies were essentially mixed if you look at things. To finish off this sort of broad market recap, and then we're going to talk, again on Monday, we hit the market from three directions. We'll talk macro, then we'll talk sectors, and then we'll talk individual stocks. So let's look at the intermarket analysis chart list and just sort of tease out some of the ideas here. When I'm looking at interest rates, when we think about a lot of the banks reporting this week, for me, that is very much an interest rate story. If you want to understand the trajectory of those stocks and the upside potential of those stocks, it's about interest rates. It's about the yield curve and the potential of banks, especially like regional banks, to make money on a steeper yield curve. I'm struck by the chart of the TLT. I have this, area from the second half of last year. Actually, sorry, this is the second half of 2019. It's the beginning of 2020. This is the TLT that we're looking at. And if I take this highlighted area that I shaded a long time ago and just kind of extend it to where we're at now, you can see why, it is very, very reasonable that we're at this sort of inflection point with bonds. You had the TLT going lower, bond prices going down. You had this bullish divergence with the momentum totally drying up and basically sloping higher as prices were going lower. That's right as we're hitting a significant support area. This is where we bottomed a number of times toward the end of 2019 before the big rally, the first quarter of 2020. We've come right back to that level. So no matter what the long-term trajectory is, it is totally reasonable that we get a bounce here. And that's one of the things we talked about recently, sort of this inflection period, this rotational period. And I think stronger bond prices and yields that are sort of stable to down makes sense. At some point, the question is, does this price continue? Do we break below that range for the first time since the late 2019? And that is what is going to make this other chart continue to go higher. Right. So, whoops, not this one. This one, here's the TNX, which is what we usually use to look at the 10-year yield. You see the inverse of the TLT chart, where you see higher yields. You see the bearish divergence suggesting some weaker yields. That's sort of what we've seen. We've seen a stop in the increase in yields, but not really a break lower. It's still sort of a consolidation phase. And the question is, does this complete higher? Do we rotate out of this sort of sideways coil pattern and break to new highs? Do we continue to push higher on rates? My guess is that we do, and that's what's going to fuel some further upside in some of the bank charts in the coming months. Having said that, it's all about how long this rotation sort of plays out. We're not seeing any signs, at least I'm not, that trend is over. We talk about the dollar index, and as I'm looking at a chart of the dollar index, you can see that we rallied into the end of March. We became overbought. Last time we were overbought was here in early March, where we pulled back for about a week or two. We have now pulled back for about a week and a half. And I think it'll be interesting to see if you have a similar repeat to what we saw in February, which is the RSI going down to around 40. That's about where things bottom out in a bullish cycle. If the dollar is in a bullish trend, that's kind of where you'd probably expect a bottoming sort. We're not there yet, which means you could see a bit further downside for the dollar index. And the question is, does it rotate back to the upside? Again, a stronger dollar environment is something we did not see for most of last year. That would be the big question. The last chart, just to finish up, was looking at the GLD. And again, it's sort of like the chart of the TLT chart of bonds or interest rates really hasn't broken out. It's more consolidating. I think all of those are sort of in a consolidation pattern, a digestion range, if you will. And the question is, which way do we rotate? I think with the gold chart, the question is, does it break down below support around 157? And if it does on the GLD, I think that's a pretty scary potential downside move for gold. And it measures down, I would argue, to the levels that we saw here in late 2019, early 2020, which is a couple, about 20, 30 points below where we're at on the GLD. That's our market recap for now. And again, I'm seeing a lot of these major, asset classes in rotational mode still. The S&P moving higher. As we get to our discussion of sectors and charts, I think you'll see why I think we're still in rotation mode, even though the S&P has gone to new highs. Let's go to our next segment, which is called Sector Setups. This is where we focus on the 11 S&P sectors and how they are relating to each other. The way we usually do this is using the RRG graph. This was designed by Julius de Kempener. Check out his show Sector Spotlight if you want more information on this approach to visualizing rotation. But essentially, the 11 S&P sectors are rotating around the 0 point, which is the benchmark. Up and to the right, green heading northeast is the strongest of outperformers with increasing momentum. Heading southwest in the red, diagonally down and to the left is the weakest position. That is a underperforming sector with increasing negative momentum. So where we are right now, well, energy has been the strongest by far on a long-term RRG. You can see that it's going straight down though. So what that tells you is overall, even though it's still been a relative outperformer, the momentum has totally come out of that. And if you zoom out a little bit and sort of rotate these in the last couple months, you can see how, as we rewind, you can see energy was certainly in a position of strength here at the beginning of the year. You can see how it quickly starts waffling around, rotating sort of in a southeast and now in a due south direction. That's showing you that even though it's still outperformed over the long term, the momentum is coming out of it. It's getting weaker and weaker. What is improving, though, is if you look just below there, you'll get financials. So financials starting to turn a little bit to the east, which is an improving relative profile. When I'm looking at a lot of the financial charts, we'll look at things like B of A and Goldman, even the regional banks index, and you'll see that overall they're holding up pretty well with the potential to break out, this week and in the coming weeks. I think that's the real thing you'd be looking for. So overall, potentially a pretty constructive pattern. What's most impressive to me on the weekly RRG, though, are industrials and materials. You can see how they are rotating out of the weakening quadrant back in to the leading quadrant. And that rotation, that sort of clockwise rotation further to the right of the zero line, I've always found to be a really encouraging signs. The fact that, some of these cyclical sectors like industrials and materials breaking out is potentially an interesting signal there. What is not working on this time frame are things like utilities, which is way over here, consumer discretionary, which is down here, healthcare, and technology, all of which have rotated lower on this weekly relative graph. Let's look at the 11 S&P sectors using the candle glance page. So this is a chance to just take a step back and see what sort of patterns emerge, what sectors are making new highs, what sectors are breaking out, which ones are breaking down. What immediately jumps out to me as I'm looking at these 11 charts is the outlier that is energy. If you look, most of these are at or near new highs, and in the last month have had stronger movements. In particular, you see consumer discretionary breaking out to new all-time highs, communication services, all-time highs, real estate, technology, materials, industrials, these strong profiles, financials as well, breaking above their March highs, continuing this uptrend. Healthcare may be one of the more constructive ones. We'll come back to that in a second, but what is the least compelling is energy. What's interesting about it is you can see how the relative strength has really dried up in the last month. And this is why on the RRG, what it's telling you is overall, it's still higher than it was maybe 6 months ago, but you can see in the last month, it's actually rotated lower. And I think that's the real question for a lot of energy charts as we look at them. You can see what happened here in mid-January. We had a nice run. This was making new lows here at the end of October. Financials too, it looked pretty brutal, and they turned on a dime, broke out to the upside, a couple gaps higher on the XLE, and then you can see this pullback here in late January, pulled back to the 50-day moving average for the first time since that initial gap higher. We've now rotated to a new long-term high, threatening a new 52-week high. We've pulled back once again to the 50-day moving average. What's happened with a lot of energy stocks, they've now established a lower high with the XLE around 50. The question now is, do we make a new swing low? So I think this chart is probably one of the more actionable in terms of at a really key point. If you've held on to these energy stocks that had been working so beautifully and now have struggled, I think you're at that point of no return. Does it hold the 50-day? Does it hold that swing low from March? If these stocks do, arguably, this is the nice, potentially setting up for a new leg higher and a nice appreciation in coming weeks and months. If we break down, we don't hold those levels, I would be very concerned about the potential to retrace even further down to the 200-day. I don't know if you'd want to ride that sort of thing that much lower. And the question is, can you rotate somewhere that's healthier and more constructive between now and whenever that would happen? So energy really at a key defining moment. Healthcare is a challenging one. If you look here, this is the chart of healthcare relative to the S&P. The reason why I rarely talk about healthcare with any sort of positive energy is because this is what the relative strength of healthcare has done for the last year now. It's been in a downtrend. You really haven't been paid to own healthcare stocks over, the S&P, over other things that have done better. So even though it's rotating in a more positive direction, absolutely right. It is making new highs and new lows in the last month or two. That's absolutely right. It's potentially rotating back to a period of accumulation and threatening new all-time highs. That is all true. If the relative strength line would just turn up a little bit, I would feel so much better about wanting to be there. I think, again, it's more of a stock picking exercise and looking opportunistically within healthcare as opposed to an allocation where you really haven't been paid to own that sector. Here's industrials. And again, if you ask me to just pick a healthy long uptrend, the XLI might be one of them, continuing to make new highs, pull back a little bit mid last week, but resolved higher, finished the week higher, pushing again to the upside today. And the relative strength line overall has been in a good uptrend. Had a period of relative weakness here in December and January, but look at how that's resolved back to the upside. So I think there could be certainly some opportunities there. Materials also look relatively encouraging, although again, I'm always less excited when the relative strength line hasn't done much because I'm much more tempted to go where the relative strength is, right? If you want to outperform the S&P, go into sectors and stocks where the relative strength line is going higher. That is our segment on sector setups, looking at the 11 S&P sectors. And again, I'm thinking energy as an outlier and one that you really want to see if it's able to hold. That's a chart I would focus on, and also financials given the earnings we have coming out this week. Let's take a quick break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we break down the market activity using charts, using the power of data visualization. As a reminder, we love to hear from you. We'll do a mailbag segment tomorrow on Tuesday's show. We'd love to answer one of your questions on the air. Shoot us an email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv. Just tag us in the comment on our YouTube channel. Just put a comment below the video that you're watching. Again, any question is fair game. Questions about technical analysis, particular tickers, visualizations, charts, rotations, whatever it is. We'd love to address your question in our next mailbag segment. Also, as a reminder, check out StockCharts TV on demand. It is our newest addition to the StockCharts TV lineup. Go to stockchartstv.com, use your email, set up a free account. You can do the same on any of your mobile devices. We're on all the app stores. Check it out. It's free and it's really, really good. It's good to have you join us today. And as we continue our discussion on Mondays, we've talked about the big picture and sort of this rotational environment I would argue we're still in. We talked about sector setups and how you're seeing some strength in the cyclical sectors and also weakness in places like energy. And I think at a really important level to pay attention to. Now it's shifting stocks. And this is really fueled by my weekly effort of going through charts. I had the added benefit this week of taking a break and sort of looking with fresh eyes. We literally unplugged for the last week. We did a lot of hiking and not looking at any screens for a while, which was tough to do. I'd encourage you, and I hope you're able to do the same at some point because it had been a long time since we've been able to unplug like that. But looking with a fresh perspective, what I did not see, what I did not struggle to find were charts that look constructive. And I think my initial reaction looking at the S&P and looking at a lot of groups, there's some decent charts out there. I also found plenty that did not look so great, and we're struggling a bit. We're going to start looking at semiconductors, which overall aren't bad. But again, I don't think a ton has changed in the last week in terms of where we're at. I've certainly saw the S&P make all-time highs and was struck by that as I did my initial dig into the charts. But even there, I think you're finding some breadth divergences, which we'll talk about in a little bit, that could certainly be an area of concern. The biggest change that I saw were the FAANG stocks, mega cap technology consumer names rotating to new all-time highs, and Microsoft looking how it does is going to fuel things higher. Let's look at some of the individual charts that came out. Looking at the semiconductor ETF, the SMH, again, it's now retraced its all-time high there from February. The SMH has now reached that level, and now we've paused a bit. And the question is, does it resume? Does it break out to the upside, or does it hold steady here? The relative strength on semiconductors have been really flat for the last 2 to 3 months. If you look on the 2-year chart here, a long stretch of outperformance and then the sideways mode. So when I think about a market in rotation, the relative strength of semiconductors, the price of semiconductors really not breaking out, is one of those reasons why I think the market feels like it does, which is more rotational. If you look at the last, take this last month out, you can see that it's almost a broadening pattern of higher highs in January, lower lows in February, January to March. Sort of an expanding range, which usually is a topping pattern, but we've certainly not seen the confirmation of any breakdown. We're now back to the upper end of this range. So, again, Tesla's in a similar boat, not really breaking out at the upper end of the range. That's great. The question is it able to follow through to the upside? Now, you'll be happy to know, of course, that myself and my fellow chart, what do we call it? Chart Madness, our March Madness themed stock picking debate. The four of us, Greg, Grayson, Tom, and I have resumed smack talking. At least I guess I instigated that today. And I highlighted these two charts for everybody, which was Intel, which Greg and Grayson had suggested was the better pick over the next 6 months. Moving lower today, about 4%. Most of the semiconductors were down. And then my pick and Tom Bowley's pick was NVIDIA, which is up on the same day, almost 6%. So you have this real bifurcation of NVIDIA working and a lot of the other semiconductors not today. Now, I'm doing that in a very tongue-in-cheek way. I don't think you can extend one day's move and draw any long-term conclusions. Please don't take that away from it. But I think it's worth noting that this space, the reason why the SMH is flat is you have kind of this divergence between some of the names within there. So it might be interesting to look at some of the individual stocks, and you can see where the last 2 months, it's essentially NVIDIA's been range bound, right? It really has been for the last 6 months, to be honest with you. But we've sort of rotated between overbought conditions at the highs, oversold conditions at the low. We tested the 200-day a couple times, bounced back up, and now we're at the upper end. And my question is, does NVIDIA have enough to push through and break to new highs? I don't know if you can answer that question just yet. Today's rally sort of puts it in play and tells me to start following it. I mentioned Tesla before, and again, today's bounce higher is decent, but again, this is still below a declining 50-day moving average. So it's hard for me to get too excited about this, especially because it hasn't broken above resistance. Now it's right at 700, which is where it's hit resistance many times in the last 4 to 5 weeks. So I think getting above there, getting back above the 50-day moving average for the first time since February would certainly make me be a little more of a believer in the Tesla chart. But having said that, again, over the last month, you've seen a pattern of higher lows. That's good. The question is, can it make a higher high? Can it break above its swing high? It has not done that yet. Until it does, I'm hesitant. I'm skeptical, but remains to be seen for sure. Top ranked scooter name right now is Kohl's, which is kind of funny to me, I guess, only because I'm so used to it being Tesla and other names that we've been talking about for so long. But it's a lot of retailers that are up there. Kohl's is in the top 10, Macy's, Capri, Tapestry. These are all stocks in the top 10 scooter rankings. Looking at the large cap space in particular, the long-term trend on a stock like Kohl's is actually pretty meaningful, right? It's pretty positive. Again, when I talk about a market in transition, a rotation, again, the stock isn't making new highs just yet. It's sort of testing its high from mid-March. We pulled back to the 50-day, a nice bounce, which I think is very encouraging. And now the question is, does it break to new highs? Overall, I think this is setting up well. I would never feel that bad about owning charts that look like this with the relative strength sloping upwards. In general, that tends to be a pretty good place to be, all things considered. Tapestry, a similar chart, but and another pullback to the 50-day, I think is setting up very well, not yet overbought and overall in decent shape. So some good charts there. We're jumping around a bit, but again, when I'm thinking of why the market went up so much last week. I'm looking at this chart, Microsoft. This may be the one that I would hold up to you. Again, rotating higher hasn't been a fantastic chart, and on a relative basis has really done nothing for you in a year. So that's worth noting, right? Really haven't gained much from owning Microsoft, but the last week has certainly put on some upside potential. It's broken to new all-time highs again. That's after breaking out in January. That's a pretty solid move. The question now is, it's overbought, and do you have a similar pattern to previous overbought conditions where you have a bit of a pullback afterwards? That's what I would be looking at through the remainder of this week. I mentioned the weakness in energy stocks, and I think ConocoPhillips, breaking down through its 50-day moving average. Same with the XLE, similar sort of pattern. Halliburton is not a great chart. And again, it's not horrible, right? These are not charts that have broken down dramatically. It's just relative to other charts, they don't look as good. And this is why the relative strength line is struggling so much. A lot of other charts to look at. We don't have time for all of them. Financials are certainly going to be on tap. We'll probably talk about those more tomorrow and Wednesday as we get into the meat of some of those earnings. Airlines are another one that have come off. Things in the rotating lower list are things like airlines, cruise lines, gambling stocks. The reopening trade is struggling a little bit. And I think the question on a chart like American Airlines, is this a lower high, right, from earlier this month? You've made now a lower high from mid-March, and the question is, does that continue to show some weakness? Whoops, I mistyped Delta's ticker, DAL here. DAL not as bad. It hasn't really made a lower high yet, so I think it's still in wait and see mode. Does it hold the 50-day as it pulls back? So I think it's overall a chart that's not bad, but I'm seeing bearish divergences. I'm seeing some weakness in some relative to others, and that's what I'd be looking for as we get into earnings there. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number one. Hold on, I don't actually have it up. Here it is. Boom. Chart number one is the S&P market trend. When I'm looking at the market trend yesterday as we got back home, and I was looking at the charts, as of last Friday, my medium-term model had been negative since mid-February. So for 2 months was negative, now has turned back positive. So long-term, medium-term, short-term, all positive. When that's the case, that tells me overall that the market is in decent shape. That tells me overall to be looking opportunistically for charts that are good, and to lean into things that are working, and to look for opportunities elsewhere. That negative pattern on the medium-term signal had caused me to be certainly cautious. Now that that's positive overall until proven otherwise, the trend remains very strong, and I think that's what I'll be looking for on the market trend model. Now, having said that, all is not perfect, all is not beautiful. When I'm looking at why the market rallied, again, I'm seeing a rotation higher on some of the names that had been not really pulling their weight, if that's a way to put it. Things like Microsoft and Apple and others, which again, overall are not exceptionally good charts, but that have, not all of them, but some of them certainly have rotated back higher. And that's a lot of cap moving up, which is pushing the indexes up overall. Here we're looking at a chart of the S&P with the percent of the S&P members above their 50-day moving average, which is up to 90%. But look at this one. If you look at the percent of NYSE members above their 50-day moving average, it's only at 71% or so. This is not updated yet through today, but certainly there's a big divergence there. So what has happened where the S&P breadth has improved, but the NYSE breadth has not improved? And I think this relates to the chart of small over large, which has continued to move higher. The breadth measure, another breadth measure we'll look at in a moment here, which also speaks to some internal weakness. The smaller end of the market cap range has not really been participating. This is more about the large cap, the mega caps catching up, which has pushed the S&P higher. It's not as much about the lower end of the cap range, and that's why the large cap, breadth is looking good. The small cap breadth, or more equal weighted breadth, not looking as positive, not confirming. Also, if you look at the advanced decline lines, right? So the S&P advanced decline line confirming new all-time highs, the mid-cap advanced decline lines confirming all-time highs, the small-cap advanced decline line not doing so, also the NYSE as well. So I think looking at small caps and see what they do this week is going to be very, very key. Folks, for StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.